All right, the next thing we want to talk about is Part D. So let me get there. So first thing we're going to talk about is changing inventory methods. And so here, and again, we talk about this, I believe, in Chapter 20 in more detail. I don't know how much more detail you can get than what we're going to talk about, and I don't recall. But anyway, never hurts to repeat certain concepts. So if the company decides to change their inventory method from FIFO to LIFO, LIFO to FIFO, weighted average, whatever, in most cases, that's going to, the company is going to be required to treat that retrospectively, meaning they've got to change uh, the numbers to where it looks like they were using the new method all along. Can't even talk. Ugh. And so that includes changes in inventory methods, any inventory method other than LIFO. With LIFO, you have to treat prospectively, meaning from the time of the change going forward, you just use LIFO, and your base is whatever ending inventory is at the time of the change. Well, why do you do that for LIFO? Well, um, most companies are not going to have historical uh, information on their layers of inventory from the past when they weren't using LIFO. They're just not going to have the information that they need to recreate those layers. So for that reason, they just start with whatever ending inventory is in the prior period as their base and just go forward using LIFO. But FIFO, weighted average, you've got to treat it retrospectively. And so that would mean revising uh, the current financial statement and any comparative financial statements from a prior period so that everything is uh, apples to apples. The other thing you're going to do is make adjusting entries to any accounts that are affected. And then last but not least, you're going to disclose additional information and so like I said, we already talked about that. And so here we have an example. This company began business in 2015. Inventories reported at 2015 or in the 2017 year-end balance sheet determined using the average cost method was $123,000. In 2018, they decided to change to the FIFO method for inventory cost flow assumptions. If the company had used the FIFO method in 2017, ending inventory would have been $146,000. So what steps should AutoGeek take to report this change? Well, they've got to report a debit let's see. So they're moving to, okay, so they've got to debit inventory for $23,000, and then they're going to have to make a prior period adjustment to retained earnings also for $23,000. And the other thing is you've got to provide a disclosure note that gives a clear explanation as to why this change was preferable. The note should indicate the effects of the change on income from continuing operations, net income, each line item affected, the effect on earnings per share, and the cumulative effect of the change on retained earnings or other components of equity as of the beginning of the earliest period presented. So as I said, when you're changing to the LIFO method, it's impossible to calculate the income effect on prior years because you would have to make some assumptions as to when specific inventory layers were created in prior years. And so there you just change LIFO retrospectively, and you use LIFO from there on. The base year is the beginning inventory in the year the LIFO method is adopted. And again, just like you do for any other change in cost flow assumption, you've got to indicate in a disclosure note why you're doing this and the effect on all those things I talked about. Oh, the other thing you have to do is explain why retrospective application of LIFO is impracticable, usually for those things I mentioned. Next, let's talk about inventory errors. And I know it seems like we've talked about this before. So what is an inventory error? Well, it's either an overstatement or understatement of ending inventory. This could result from a mistake in physical count or pricing, or in recording purchases. And so the treatments depend on the type of error you have and when you find it. And so if the error is discovered in the same accounting period, you simply make a reversing entry to the original entry and then turn around and make the proper entry. Now, if the error is discovered in subsequent accounting periods, you have to retrospectively restate the previous year's financial statements because it's incorrect. Incorrect account balances are corrected by journal entry, and a correction to retained earnings is reported as a prior period adjustment to the beginning balance in the statement of shareholders' equity. You also have to list a disclosure note describing the nature and the impact of the error. might be helpful to visualize the effect of inventory errors. If you have an error in recording purchases, you're going to have an error in ending inventory and cost of goods sold, because revenues minus cost of goods sold equals net income. Well, gross income, other expenses are reduced as well to come up with net income. Because net income is added to beginning retained earnings and it's wrong, that means your ending retained earnings is wrong. So bottom line is an error in recording purchases or calculating ending inventory affects cost of goods sold, therefore net income, and therefore retained earnings. So here we have a situation where a mathematical error in 2017 caused an $8,000 overstatement of ending inventory. Because ending inventory is overstated by $800,000, what should have happened is that $800,000 should have been included in cost of goods sold. Therefore, because your ending inventory is overstated, cost of goods sold is understated, therefore net income is overstated, thus retained earnings is overstated in 2017. Now, what does that do to 2018? Well, beginning inventory for 2018 is the same as ending inventory for 2017. Well, if it's overstated, that means that cost of goods sold is going to be overstated, whereas it was understated in 2017. So essentially what's happened is you've had a self-correcting event going on here. You know, if you catch this in 2019, it's self-corrected. However, if you find it in 2018, you're going to have to go back and change your numbers in 2017 through adjusting entries and prior period adjustments to retained earnings. But if you get to 2019 and you find out this error happens, then you don't have to do anything because it's self-corrected. So the understatement of cost of goods sold in 2017, while the overstatement of ending inventory, thus the understatement of cost of goods sold, results in beginning inventory being overstated at the beginning of 2018. Thus, cost of goods sold is overstated by the same amount. And so since it was understated, cost of goods sold was understated $800,000 in 2017, now it's overstated by same amount. And note that there's going to be an understatement of $800,000 in 2018, whereas there was an overstatement in net income in 2017. Thus, they've canceled each other out, and retained earnings is now correct going forward in 2019. So if the error is discovered in 2018, the following year, the following journal entry would be made to correct the error. You would debit or subtract $800,000 from retained earnings by debiting it, and then you would reduce your inventory by $800,000 by crediting it. And then if the error is discovered in 2019, you don't do anything. No correcting entry is required. Self-corrected. Still have to do a disclosure note though if you find it subsequently. All right, so that's it for chapter 9. Hopefully it wasn't too much of a burden listening to me because I feel horrible.